Joining us for more is Joshua Barker from RiverX. Josh, it looks like we could hit records today again.
Yeah, again, we're just hovering around these nice, quite high levels, which is obviously good to see. But it does make finding opportunities a little bit harder, especially with some muted growth that's expected over the next 12 months. After such a good November, I think the Dow was up 7.5% in November, and typically when you have a good November, sort of trickles on to the December Santa Claus, grind higher rally. So I think that's probably what we're most likely to see going forward anyway.
So do you think we're going to continue to see records in the last few weeks, or it's sort of going to be a bit of we'll get to one and pull back and some consolidation? Because it kind of seems like November was already the Santa rally.
Yeah, exactly. So probably just modest, maybe 1 or 2% at most, just to sort of, sit at those high levels, I think. We've had a really good year, we've had a good month, and it's just continued on. Growth expectations for next year are somewhat a bit more conservative. In the US, they're sort of saying between 3 and 9% is sort of that forecast at the moment from a lot of the big houses. So I think, and that's really pricing everything in perfectly. That's assuming really strong earnings growth to continue. That's also assuming a little bit of a compression in valuations as well, but the earnings to play catch up with that. It's assuming a lot of really blue skies things, with Trump coming in and being supportive but not being inflationary, rate cuts still continuing. So I think there's very little upside surprise left in the US market, and by default our market. I think we'll probably underperform that 3 to 9% just marginally, with the banks being where they are, and the materials just being a little bit sticky with the China news.
Yeah, let's talk about some of the material moves. I mean, Northern Star acquiring De Grey. It looks like there could be some more potential golden acquisitions occurring in the space.
Yeah, it makes them a really big player at the moment. A $5 billion acquisition is definitely not small in the grand scheme of things either. So yeah, quite a large acquisition, probably seeing a bit of consolidation. We saw a few of the other smaller miners that are around a similar market cap also boost. Maybe some speculation that they're going to have that buyouts, like Gold Road Resources broke out to an all-time high yet again yesterday. So maybe a bit of speculation there going on that this is going to continue to occur anyway as well. All
right, let's talk about GQG falling quite significantly. Yeah. A broker downgrade, but what's sort of behind the broader story there?
Yeah, so essentially they have a fair amount of exposure, but nothing drastic, to Indian company Adani, which has sort of been caught up in a little bit of speculation on the personal front. Very similar to sort of a MinRes story, or even a WiseTech story. These things are impossible to predict, and a lot of the time no real material impacts to the actual financials, the businesses. If you think about the actual underlying assets that GQG invested in, it's things like shipping ports, it's infrastructure, it's a lot of these, sort of continuing on operations that, whether the person heading up the company is going to be facing backlash, like we saw with the WiseTech, that share price performance, and obviously the company fundamentals are going to be really unimpacted by that over a longer period of time. We have seen a knee-jerk reaction, so about $1 billion flowed out since that news broke, but again, they've been averaging $2 billion in inflows. So whilst it's going to reduce things, it's still expected to have inflows, which is the number one thing for a fund manager. And I think they'll continue to do well, and I think it'll be very quickly forgotten in 6 to 12 months' time. I doubt we'll even remember this story. So, meanwhile, GQG is trading at a nice little discount at the moment as well.
Well, what about Findi? I mean, this is a stock that has run up so hard, but it does seem to be sort of, I guess, being punished a little at the moment. Yeah,
very volatile. This stock's still up 300% for the year, so important to keep in mind. So you're going to see these sort of knee-jerk reactions again with such a high performing stock, and it was very, very much just slightly under its expectations. It still could meet its guidance, if it has a strong 6 months to come, which, for a stock that's up 300%, probably possible, or you'd definitely back that horse anyway. And even if it does come anywhere near close to the lower end of guidance, which is around 30 million in earnings, it's trading at a 300 mil market cap. So you're sort of paying around 10 times that 6 month forward earnings essentially, which is not about, when you start to get it to 8 and 9, obviously it looks very ugly on the charts from a 2-day performance. It's still up for 3 months, the last 3 months. So it could be a really good buying opportunity if you do believe in the company long term. And it's one of those ones where you're going to see a lot of volatility come through, and it can be a good opportunity to pick it up. With the market trading at where it's at all-time highs, you sort of need to be a little bit more creative in your stock picking and identify these sort of short-term catalysts. I think with GQG and Findi, I think you're actually pretty well placed in a short-term and long-term buy with both of those. So I think it's ticking a lot of the boxes just on being a short-term pullback. Obviously a little bit of volatility, so maybe not throw the kitchen sink at it, but I think they're two really good businesses that are just pulling back at the moment anyway.
You touched on the banks there. I mean, the valuations here and CBA trading on a PE of 27 point something. Everyone sort of seems to be saying you've got to get out of the banks. I think we also had a Citi saying that potentially there could be a 30% decline from the banking stocks in 2025. Yet they still seem to defy the odds. What's RiverX's view?
Yeah, look, it's just one of those stocks that people don't want to sell at the end of the day. You look at its valuations compared to something like a JP Morgan in the States. I think it's like 2.5 times valued in terms of a business compared to like the revenues and earnings that it does. So I don't think any international fund managers or anything like that are going to be making the call to go and buy CBA at these levels. But what's going to stop it from having that such big declines and maybe just staying at these levels or even grinding higher, potentially, you never know with CBA, you never bet against it, is just a lot of that sticky money. A lot of fund managers wanting to have it on their books because you might look a little bit silly if you don't have that as one of your top 10 holdings with the way that it's gone over the last 12 months. But also just everyday mums and dads not looking to sell the stock because it's been really favourable towards them. And at the end of the day, whilst the index returns may be somewhat disappointing over a long term, we do have some great companies on our market. Like I think the Aussie tech names, outperformed the NASDAQ this year so far. So we do have some great quality names, but I think it's very much a stock picker's market, and CBA is one of those ones. I'm more favourable towards it over the long term than the other three anyway.